You've worked hard for your money. It deserves a good home. Investing can be a fantastic way to watch your savings grow, but it can also feel like a maze full of confusing terms and risky choices. Don't worry, you're not alone. Many people feel overwhelmed by investing, but making the wrong moves can seriously set you back. That's why we're here to help. Let's see some common investment mistakes to avoid if you're a beginner in the stock market or you're new to stocks. So, you can save yourself from some trouble, heartache, and lots of money. One of the most common pitfalls for new investors is buying stock in a company on the brink of bankruptcy. It might seem tempting to snag a bargain when a stock price plummets, but this is often a risky gamble. Companies facing bankruptcy typically experience a sharp decline in their stock value, and it's rare for them to recover. In most cases, shareholders end up losing their entire investment when a company goes under. Avoid the temptation to try and time the market by buying a stock that's already in free fall. In the world of investing, excitement and hype can be contagious. New and trendy investments often capture attention, promising extraordinary returns. However, it's crucial to approach these with caution. Investing in something solely because it's popular or generating buzz can be a recipe for disaster. Remember, past performance is not indicative of future results. Just because an investment has yielded impressive returns in the past doesn't guarantee similar success in the future. Many investors get caught up in the frenzy, buying at inflated prices only to see the value plummet when the hype fades. For instance, the dot-com bubble of the late 1990s is a classic example. Fueled by excitement around internet technology, investors poured billions of dollars into companies with little to no revenue, driving stock prices to astronomical heights. When the bubble burst in 2000, many of these companies collapsed, leaving investors with substantial losses. Instead of chasing the next big thing, focus on conducting thorough research and due diligence. Understand the underlying fundamentals of an investment, assess its risks, and determine if it aligns with your financial goals. By resisting the urge to jump on the bandwagon and making informed decisions, you can protect your hard-earned money from the pitfalls of investment hype. Online forums and message boards can be a hotbed of speculation and misinformation. While it might be tempting to dive into these discussions, it's often a waste of time and can lead to poor investment decisions. Many of the people posting on these platforms are inexperienced investors or even trying to manipulate stock prices. Focus on reliable sources of information and avoid getting caught up in the hype. Day trading, or buying and selling stocks multiple times within a single day, is a high-risk strategy that's rarely successful for beginners. It requires extensive knowledge, experience, and quick reflexes. Most new investors who attempt day trading end up losing money. Instead of trying to outsmart the market in the short term, consider building a portfolio of quality stocks and holding them for the long term. Imagine trying to catch falling raindrops with a teacup. That's a bit like day trading. You're constantly reacting to tiny price fluctuations, hoping to catch a quick profit. It requires intense focus and lightning-fast reflexes. On the other hand, building a portfolio of quality stocks is like planting a garden. You carefully select strong, healthy plants, stocks, nurture them with patience, long-term holding, and over time, watch them grow and flourish. While it might not be as exciting as day trading, it's a much steadier path to financial growth. Predicting market highs and lows is nearly impossible, even for seasoned professionals. Trying to time the market by buying when prices are low and selling when they're high is a risky strategy that often backfires. Instead of trying to guess market movements, focus on building a diversified portfolio and investing regularly. This approach, known as dollar-cost averaging, can help you reduce risk and increase your chances of long-term success. Warren Buffett, often referred to as the Oracle of Omaha, is the most famous investor who is also known for his long-term investment approach. Despite his legendary status, even Buffett has acknowledged the challenges of consistently predicting market movements. So, how could anyone else? It's important to consider the overall market performance when evaluating your investments. A stock that's down 10% might seem like a poor performer, but it could be outperforming the broader market. Conversely, a stock that's up 20% might not be as impressive if the market as a whole is up 30%. By comparing your investments to relevant benchmarks, you can get a better sense of how well your portfolio is performing. A dividend is a portion of a company's profits paid out to shareholders. While tempting, extremely high dividend yields, often above 20%, can be a red flag. Such hefty payouts might indicate financial trouble for the company. There's a risk that the company could slash or eliminate the dividend entirely, potentially causing the stock price to plummet. It's really important to dig deeper into a company's financials before investing solely based on a high dividend yield. So, while dividends can be a valuable source of income, it's essential to look beyond the yield. Placing all your financial eggs in one investment basket is a risky gamble. Even the most promising companies can face unexpected challenges. By spreading your investments across various stocks, bonds, or other assets, you significantly reduce your exposure to losses. Imagine your portfolio as a sturdy table with multiple legs. If one leg weakens, the table remains standing due to the support of the others. Diversification is your portfolio's equivalent of insurance, providing a cushion against market downturns. Remember, the goal isn't to predict which investments will soar, but to mitigate the impact of any single investment's decline. A well-diversified portfolio is a cornerstone of long-term investment success. E&G volume is a crucial factor to consider when investing. It represents the number of shares of a stock that are bought and sold on a specific day. A stock with low trading volume can be difficult to buy or sell quickly, especially if you own a large number of shares. This lack of liquidity can significantly impact your ability to enter or exit a position at your desired price. To gauge a stock's liquidity, look at its average daily trading volume. A generally accepted rule of thumb is that a stock with an average daily trading volume of less than $10 million might be considered illiquid. While this isn't a hard and fast rule, it's a good starting point. Remember, the higher the volume, the easier it is to buy or sell a stock without significantly impacting its price. Before diving into the stock market, it's important to establish a solid financial foundation. An emergency fund is your safety net for unexpected expenses, like medical bills, car repairs, or job loss. Using your investments to cover these costs can force you to sell assets at an unfavorable time, potentially eroding your gains. Prioritize building an emergency fund of 3 to 6 months' worth of living expenses before allocating funds to investments. By avoiding these common pitfalls, you can increase your chances of achieving your long-term financial goals. Remember, investing is a marathon, not a sprint. Stay patient, stay informed, and focus on building a diversified portfolio that aligns with your financial objectives. Ready to start your investment journey? Check out our other videos on our channel for more in-depth insights and tips. And don't forget to subscribe for regular updates on financial literacy and investment strategies. Let's build a financially secure future together.